Hello everybody and welcome back to another awesome YouTube video. And in today's episode, it is a little bit of a longer episode. Usually I do, 10-minute, maybe even sometimes 5-minute videos. From time to time, you'll see a 20-minute video. But in today's episode, we are going to be doing a lot longer of a format. And that's because we have a lot of things to talk about. And this video, if you clicked on it because of the title, is going to be on ARK Invest's big ideas for 2021. And it's pretty much very, very similar to what they're probably going to do in 2022. If you're watching this in the future, a lot of it hasn't really changed. They have just gotten more and more in depth. But in today's video, I'm going to unload pretty much everything that they've put into their research. And you guys are going to be able to extract all that information without having to read every single white paper or really even reading this PowerPoint. If you wanted to watch this or listen to this in the car while you're driving to work, or maybe as you're getting ready for the day, that's what this video was intended for, is to give you guys all the knowledge that you possibly could get from this content in a much more condensed format. So hopefully this brings you a ton of value. If it does, don't forget to smash the like button. This video took a long time to put together. Honestly, the editing in this is gonna probably take me a few days, if not a few weeks, because it's such a long episode. And if you wanna see more videos like this, and if you wanna be in the know when I post videos like this, or if you just love making money in the stock market or investing in general, make sure to smash the subscribe button as well. And without any further ado, let's dive into the big ideas presentation. Roll the intro, let's go. All right, welcome back and long time no see. And today we're going to be talking about big ideas for ARK Invest. This is the ARK Invest Management Corporation presentation. Honestly, I'm super excited to bring this to you guys. It's a long time coming. I've been thinking about doing this video because I haven't seen a lot of people talk about this. And in fact, I don't see a lot of people really diving deep as I am about to. But I think it's going to bring you a ton of value if you watch this all the way through. You're going to get a lot of investment ideas and really why ARK Invest is investing the way they are, and honestly why I've been investing the same way, because really it comes down to all the innovations that society is going through right now that's really going to impact and change how civilization evolves into the future. And a lot of the things mentioned in this video is going to dissect exactly that. All of those industries that we're going to be talking about today are doing just that. They are changing the way that humanity and really the earth is going to operate over the next 5, 10, 15, 20, and even into the 50 and 100 years time. Obviously, these things can change. Obviously, these things can be disrupted, but they are the future. And that is why ARK is investing the way they are. And that's why I'm investing the way I am. So anyway, long story short, let's dive into their presentation. Obviously, this is for informational purposes only. That's what they say down here. So it's not anything like investment advice or anything like that. But ARK aims to identify large-scale investment opportunities by focusing on who we believe to be the leaders, enablers, and beneficiaries of disruptive innovation. Obviously, they believe that innovation is the key to growth. The opportunities it creates can be missed or misunderstood by traditional investment managers who are more focused on sectors, indexes, short-term earnings, and price movements. ARK seeks to gain a deeper understanding of the convergence, market potential, and long-term impact of disruptive innovation by researching a global universe that spans sectors, industries, and markets. Today, we are witnessing an acceleration in new technological breakthroughs. So, this is their big ideas for 2020. And this is their disclosure. This is them saying, hey, there are risks to investing in innovation. There's obviously regulatory hurdles, political or legal pressure, competitive landscape. There's rapid pace of change, exposure across sectors and market cap, and uncertainty and unknowns that, you just can't account for. But here's the table of contents. We're going to talk about deep learning, the reinventing of the data center, virtual worlds, digital wallets, Bitcoin's fundamentals, Bitcoin preparing for institutions, electrical vehicles, or EVs, as you guys know, automation, autonomous ride-hailing, delivery drones, orbital aerospace, 3D printing, long-read sequencing, and multi-cancer screening. And we'll talk about cell and gene therapy generation 2. All right, so the first one we're going to be talking about is deep learning. So deep learning could be the most important software breakthrough of our time. Until recently, humans programmed all software. Deep learning, a form of artificial intelligence or AI uses data to write software. By automating the creation of software, deep learning could turbocharge every single industry. According to ARC's research, deep learning will add 30 trillion US dollars to the global equity market capitalization during the next 15 to 20 years. This is bearish. They think that this could happen a lot sooner. They think that this could happen in the next 10 years, but they are stating here 15 to 20 years. So deep learning is software 2.0. As you can see down here in the 70s, commercialization of software began with the founding of Microsoft, Oracle, and SAP in the 1970s. Obviously moving to the 80s, there was some innovation. Object-oriented programming made software reusable and increased its scaling capability dramatically. So this is showing the trajectory of where, we're headed, right? And this is code written by data. They're saying that in 2020, deep learning powered almost all large-scale internet services, including search, social media, and video recommendations. This is already true. This already happened, and we don't need to really talk about that too much. What the most important thing that they say is, from 2030 and on, during the next decade, essentially, we believe the most important software will be created by deep learning, enabling self-driving cars, accelerated drug discovery, and much, much more. As I said before, it's going to touch every single industry. And as you can see from here, pretty much from 2015 back all the way from 1970s when it was first created, software 1.0 was the code written by humans. Now we can already see in 2020 and moving forward, 2030, and so on and so forth, software 2.0 is the first time ever that code is written by data or by actual artificial intelligence, which is super, super powerful. Now, deep learning is creating the next generation of computing platforms. Powered by AI, smart speakers answered over 100+ billion voice commands in 2020, 75% more than in 2019. Self-driving cars. Waymo's autonomous vehicles have collected more than 20 million real-world driving miles across 25 different cities, including San Francisco, Detroit, and Phoenix. And we're not even talking about Tesla. Now, consumer apps, TikTok, which uses deep learning for video recommendations, has outgrown Snapchat and Pinterest combined. That is absolutely incredible. And the beautiful thing is deep learning requires boundless computational power. While advances in hardware and software have been driving down AI training costs by 37% per year, the size of AI models is growing much faster, 10x per year. As a result, total AI training costs continue to climb. We believe that the state-of-the-art AI training models costs are likely to increase 100-fold from roughly $1 million today to more than $100 million by 2025. Now, something to point out is down here in this gray section here, they say that actual costs may be up to 10x lower due to software tuning and on-premise hardware. So it could be 100x more expensive, or it could just be 10x more expensive, right? They're not stating a specific amount, but they are saying that it's possible that it could get this expensive by this date. Or it could be a little bit cheaper, but it's going in that direction. They don't see it stopping. So deep learning is creating a boom in AI chips. This is very, very true. We've actually had a chip shortage for a long time, really since like 2018, 2019, and a lot more problems in 2020 and 2021, where we've seen more and more chip shortages and more bills being passed to really accelerate the amount of chips that are available on the market. So as AI training costs grow from 1 to 100 million per project, like we said earlier, specialized processors such as GPUs or TPUs will account for a majority of their incremental growth. ARC estimates that data centers spending on AI processors will scale more than fourfold during the next 5 years, from $5 billion a year today to $22 billion in 2025. The upcoming deployment phase for deep learning will democratize access to AI, benefiting not only large internet companies, but also every industry in the economy. So here you have a little chart. So from 2016, you have a chart that shows, from billions of dollars, so $1 billion back in 2016 of the total AI chip market. We have grown to 2020 of about 5 billion, and they see by 2025, this could multiply pretty much 4x to 22 billion. They say about 33% growth per year is what we can account for. And this is already slowing down from 50% growth per year from 2016 to 2020. I honestly think that this actually might accelerate. So we could see $30 billion here. But again, they want to stay a little bit conservative. So that is what we're seeing now. AI is expanding from vision to language. 2020 was the breakthrough year for conversational AI. For the first time, AI systems could understand and generate language with human-like accuracy. Conversational AI requires 10x the computing resources of computer vision and should spur large investments in the coming years. This is actually something that a lot of influencers were talking about. Gary Vee is very, very notorious for talking about, artificial intelligence and voice. This is huge, and this is something that we can see right now. It's getting very, very serious. Like, we're getting to a point where it's not just language understanding anymore. As you can see here, language understanding already happened from 2018 to 2020, and it's super, super powerful. But now it's reinforcement learning. This is something that it's going to be learning what problems does it need to solve better, right? This is something that it's going to learn exactly what, questions are being asked that might not give the right answer to. And you can already see that if you talk to your Google Home device, maybe your Amazon Alexa device, right? And even your smartphones, your Siri or whatever that you have in your phone. All of those things are going to get smarter and smarter because they are going through a process called reinforcement learning. So very, very exciting, very interesting to watch for, but we don't want to stop there. OpenAI's GPT-3 is the first AI that understands language. Like, what? 10 years ago, you would have just been sitting there thinking, like, no way, I'm still reading books. Like, there's no way a computer's going to understand me besides what I type maybe on the keyboard. But even then, it's like 10 years ago, this was just code, right? We had basic programs back then, not something that could literally coherently understand what you are saying. So what can GPT-3 do? Well, it can also write emails, design web pages, right? It can write code in a dozen computer languages. It can retrieve historical facts, translate languages, diagnose diseases, converse as a therapist, and so much more. And when you put all these facts together, they say that deep learning could create more economic value than the entire internet has since the beginning of the internet. That's crazy. So over 2 decades, the internet added $13 trillion to equity market capitalization globally, and deep learning has created $2 trillion in market capitalization as of 2020. So are we catching up? Well, as you can see here, we have the share of global market cap and then the internet wave and the deep learning wave. They say that between 1997 and 2020, we have brought in about $13 trillion as far as internet growth goes, right? That's how much value has been added in the economy. At the same time, from 2020 to 2037, just 13 years into the future, not like the 23 years that we've had going backwards, right? 13 years into the future, by 2037, we could see an additional $28 trillion being added just to the deep learning sector and another $7 trillion into the internet space as well. This is crazy. This is crazy. I'm super excited about this. There's a lot of companies that, you can be investing into. And again, this is not financial advice, but here are some names that they mentioned here. Companies like Google, Facebook, Amazon, OpenAI. There's obviously other companies. Apple could be considered one. But currently, these are the main players. And that's what you want to be paying attention to because, again, if they control the market cap right now, right, the whole market capitalization of this deep learning space, and it's only $2 trillion, and it could get to 30 trillion. That's a 15x on your investment over the next 17 years. If it doesn't grow any faster than 17% per year, which I think it will. But again, we want to be conservative. We want to play the safety route. This is at least what you can expect from this space going forward. So super exciting. Hopefully that brought you a lot of value. That's deep learning. Let's dive into the reinvention of the data center. Now, data centers, these are the power plants of computation, and they are also going through a little bit of a revolution. Now, I used to work at a place where we had a data center, and honestly, it was very interesting to see how much of a difference, a little tiny data center is versus an actual building that is a huge, data center for, conglomerates, right? And we're going to get into exactly how it's changing. So cheaper, faster, and more power-efficient processors are starting to displace Intel, which traditionally had captured over 90% of all processor revenue, okay? So Intel has been around for a long, long time, and unfortunately, Intel just hasn't been innovating enough. So that is something to be said about people that are investing in Intel, right? Or Intel as a company. For cloud computing, we believe ARM, or ARM, RISC-V and graphics processing units, GPUs, are likely to emerge as the new powerhouse processors. Together, they could scale at a 45% annual rate to $19 billion in revenue by 2030. And in the data center, we believe accelerators dominating by GPUs will become the dominant processors for new workloads, growing 21% at an annual rate to $41 billion by 2030. So let's unpack that a little bit. Here is a nice little graph. If you guys are listening to this and you're not watching this, it's okay. I'm going to break it down for you guys. So in 2000, 77% of the data center architecture was legacy. It was Spark, it was Power, 77%, okay? And 23% of it was x86. This is Intel's low-cost PC-derived architecture, okay? So from 77% and 23, by 2020, it was pretty much all Intel. 92% was Intel, and then 8% was legacy, right? It was old. And by 2030, we can see as low as 2% legacy, 27% x86, right, with Intel, and 71% ARM or RISC-V. So if they can take a lot of that market cap, not only is it going to hurt the big players, mostly, you know who we're talking about, Intel, and in addition, it's going to bring a lot of revenue to these players here. 71% is a big, big number when we're talking about an ongoing, growing industry that's growing by 45% annual rate. Okay, and this is what we're talking about here. Intel seems frozen in time. This is very true. Once the world leader of semiconductor manufacturing, Intel seems to have lost its way, unfortunately, because Intel has been a really good growth company for a long time. And Intel delayed its 10nm processor by 4 years, allowing its competitors TSMC and AMD to lead the market in 2020. This is true. I mean, you could look at the stock price of AMD and you'd just be shocked at how much their growth has been, not just market cap, but also their share price and also their revenue. It's just been absolutely incredible. And Intel at the same time has been losing big name customers, Apple being one of them, and that's a huge, huge no-no when you're talking about growing, right? You want these big customers to stay with you, but when you're losing most of your revenue, it doesn't paint a good picture for the long term. And as of 2020, Intel still has not shipped that chip that they promised, and a full generation ahead of Intel, TSMC is mass producing 5nm processors. Crazy, 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 crazy. So anyway, ARM could power the majority of developer PCs by 2030. Okay, that's what they're saying. And almost all software developers write code on Intel's x86 PCs running Windows, Mac, or Linux operating systems. Apple plans to transition Macs, which are used by 1 in 3 developers, from x86 to ARM-based central processing unit CPUs over the next 2 years. So at the same time, Microsoft, which is another huge, huge company, is doubling down on its efforts to support Windows on ARM processors. Interesting. And according to ARC's research, by 2030, most developers' PCs could be powered by ARM CPUs, marking the end of the Intel x86 era. So this is just confirming exactly what we were talking about up here. And so another reason why ARM could be such a powerful force is that ARM could become the new standard in the cloud. So the public cloud, the default platform for deploying new applications, generated $140 billion in global revenues in 2020. AWS, which is Amazon Web Services, the largest public cloud provider in the world, launched the Graviton 2 ARM CPU in 2020, reducing its need to purchase chips from Intel and AMD. AWS Graviton 2 is cheaper and faster than Intel CPUs, offering 48% higher performance per dollar. Ooh, in the future, AWS is likely to migrate most of its servers to ARM-based processors. And this is just another reason why ARM is doing such a fantastic job beating out its competition. So the next slide is very similar to what we've been talking about before, so I'm not going to dive into it. I want to give you guys the most amount of information and as fast as possible. So ARM and RISC-V could become the new processor standards by 2030. That's what we've been talking about so far. And as you can see on this chart here, that's what's being mentioned. x86 is going on a huge decline while ARM is going up, and legacy is just keeping up with that as for right now. Obviously, it's making up a smaller and smaller market share, as you can see here, but because of the fact that x86 is also downtrending, ARM is going to be able to pick up from both markets as it grows. So by 2030, the accelerator should replace the CPU as the main server compute engine, meaning revenues are going to go up and up and up when we're talking about accelerators. So here we have from 2020 to 2030, the CPUs are going to go from $30, this is again in billions, so $30 billion to 27. The fact that memory is going to go from 17 to 24, that's fine, right? That's a good number. It's going up. $17 billion for storage, going up to 24 by 2030. $15 for other parts. It's going to go up to 21, but the growth for accelerators is going to go up tremendously from a total of $6 billion in 2020 all the way up to $41 billion by 2030. And again, this is just what ARC believes is happening and is going to continue to trend into the next decade. So something to pay attention to, something to be very vigilant of, because from those type of figures, that's a 21% growth per year. So seizing the opportunity, which it says sizing the opportunity. I'm pretty sure there should be an E there, but it's okay. ARK believes that server processors will transform in the next. This is just covering exactly what we just talked about, but let's talk a little bit deeper about this. So 2020 revenue in billions of dollars. Right now in 2020, $30 billion is going to the x86 market, which they believe will flip to $19 billion in the new space, which is ARM and RISC-V, and $8 billion will probably still stay in x86 space. As long as Intel doesn't do something dramatic and absolutely destroy this space, which I don't think is happening. If anything, they're getting further and further away, while this space is actually getting faster and better, and more adoption is coming as we speak. So I don't think it's going anywhere, and they believe that it's just going to increase dramatically over the next 10 years. So when talking about seizing the opportunity, there's two ways to play it. You can go out and try to buy, the companies that are actually making the technology, or you can start buying the companies that are adopting this technology, or you can do both. Either way, you're going to be at a win, because again, the growth rate is around 21%, and the winners in the space will probably grow bigger, and even the average growers are gonna, grow a little bit less than 21%, right? And probably beat out, S&P 500 numbers over the last 90 years. So again, just another thing to pay attention to in the next decade. All right, so next on the list, we have virtual worlds. What are virtual worlds? Well, they consist of video games, augmented reality, and virtual reality. According to the research, revenue from virtual worlds will compound 17% annually from roughly $180 billion that it is today to $390 billion by 2025. So pretty much a 2x and then a little bit extra within 5 years' time, which is absolutely incredible to see. Today, virtual worlds are independent from each other, but in the future, they could become interoperable, culminating in what futurists have deemed the metaverse. And a lot of people do talk about this. Even Elon Musk talks about the fact that, in the future, virtual worlds may feel like real worlds. And that might be a little dangerous and a little bit scary to some, but also very, very exciting when you're thinking about the opportunity that might bring, to people like us that are thinking about investing in this space early on. So video game monetization models are shifting to virtual goods, and this is extremely true. I've been talking about this for quite some time. As video games have evolved, so have their business models. According to our research, during the past 10 years, in-game purchases as a percent of total gaming revenue increased from 20% to a whopping 75%, and they could hit 95% by 2025. Insane. People are willing to pay a lot in-game versus just the games themselves. ARK believes that monetization of gaming will also increase. Thanks to the proliferation of in-game purchases, economic power is shifting from developers to gamers. In fact, with lower barriers to entry, many gamers have become developers. In our view, this shift has increased the monetization rates of video games. During the next 5 years, the cost per hour of playing video games is likely to increase by 20%, but will remain a bargain relative to other sources of entertainment and information. Wow. Insane. Video games are becoming third places away from home and work. So you go home, work, but video games is another place. And according to their research, the average time spent playing video games will increase from 1.1 hours per person per day to around 1.5 hours during the next 5 years. A lot of people, may not have access to games and keeping the numbers down, but really a lot of people already maybe play 1 to 2 hours per day, not even including the weekends. So this is very interesting. If the increasing trend of both monetization and time spent remains in place, in-game purchase revenue could compound 21% annually during the next 5 years, from roughly $130 billion in 2020 to nearly $350 billion by 2025. Wow. I'm super impressed by this because I love the video game space, so this is something that's really, really interesting to me. And they say that augmented reality, AR, is primed to scale. Over the past few years, companies such as Snapchat, Facebook, and Apple have increased their investments in augmented reality, encouraging widespread use of AR tools on mobile devices. I think Google is also stepping into this space, but when they did the Google glasses, not a lot of people bought them, and they just didn't really work as a product. But I think soon companies like Snapchat, Facebook, Apple, maybe even Google could have a really big place in this space. That rhymed. By 2022, consumer-grade AR headsets should turbocharge this trend. I have a really interesting video on a company. If you go to the best stocks to buy, you'll see it. I talk about a company that is doing glasses, augmented reality for workplaces, and obviously this is something that you should look into. There's a lot of companies already thinking about this technology and working on it, and they are very, very far ahead of others that might just be stepping into the space. ARK forecasts that by 2030, the AR market could scale from under $1 billion today to $130 billion. Oh my goodness gracious. And I guess if you were able to pick the winner, whether it's any of these companies or Vuzix, like I said, like the company I mentioned before, I mean, you have a huge opportunity on your plate here. And ARK believes that virtual reality could approach our modern world by 2030 based on their scoring system, right? The best in class VR headsets today achieve only about 10% of human visual immersion, right? 100% is a long ways away. And I think just like with automation of cars, where if you are familiar, Elon says that the last 2% and the last 1% becomes extremely difficult. It's like if you've played RuneScape and the last from level 1 to 92 is very, very hard to get to, and then from 92 to 99 it's just as hard. It's actually the exact same amount of experience, right? And I think the same thing can be said about this. Just like it is with cars, full self-driving is, the last 1 to 2% is extremely difficult to get to. And with virtual reality, it's going to be also the same thing. But we are still in the 10% zone. So we still have, those 82 levels until that 92 to 99 reality can really take place. And I think there's a huge market, and I think that they are onto something as far as virtual reality here. Seizing the opportunity, the revenue from virtual worlds could approach $400 billion by 2025. Right now, from 2020 to 2025, they say that premium spend is roughly about $50 billion US, and in-game spend is roughly making up around 130 of that, for a total of almost 200, around 180 billion to be exact. And then in 2025, they see this growing as almost high as $400 billion, around 360, 370. And the global AR and VR market could actually be going from less than 5 billion, around 3 billion, it looks like here, to over 28 billion. And that is going to be the VR, the AR glasses, and the AR smartphone opportunities that you could potentially see in the next 5 years. Absolutely insane, because that's a huge growth. We're talking about a 60% year-over-year growth. If this is true, this is probably one of the biggest sectors that we've covered so far in this video. Next, we have digital wallets. This is something super exciting. This is fintech. This is something that everyone likes to talk about. ARK has been talking about this for a very, very long time. They believe that digital wallets, which with Coinbase, with Robinhood, really everything is moving to the phone. I personally almost don't even carry a wallet. I mean, obviously I carry my ID and stuff, but from time to time, I don't even need my wallet to leave the house. And I think the biggest reason for that personally is because of digital wallets. So digital wallets represent a 4.6 trillion opportunity in your pocket. They believe that Venmo, Cash App, and venture-funded startups are likely to upend traditional banking by activating the mobile phones, the bank branches in users' pockets and handbags. Today, digital wallets are beginning to penetrate the full traditional financial services stack, including brokerage and lending. Digital wallets could serve as lead generation platforms for commercial activity beyond financial products. And I know they mentioned Venmo, Cash App, and other, but I think SoFi is a great example. I think Chase is doing a great job of moving online. And I think obviously, as far as lending goes, you could say Rocket Mortgage and Quicken Loans is doing good. And brokerages in general, like Robinhood, Stash, M1 Finance, there's a bunch out there, and they're all revolutionizing this space. So according to ARK's research, digital wallets are valued between $250 and $1,900 per user today, but could scale to $20,000 per user, representing a $4.6 trillion opportunity in the US by 2025. Super cool. So incubating in China, mobile payments are 2.5 times its GDP. So The reason why they use the Chinese market is because they're just a little bit further ahead than we are right now. And so China's third-party mobile payments versus China GDP, as you can see, in 2015, China's GDP was a lot higher than the China third-party mobile payments. And then 2016, it scaled to almost be the same. In 2017, it started to outbeat that market. And then obviously 2018, it doubled. 2019, it surpassed that. In 2020, we've almost tripled the China third-party mobile payments versus their GDP. Crazy stuff. Digital wallets have become a global phenomenon on this next slide. And so here are some examples of the companies that make up this sector. And obviously each continent is going to be different. So North America has Cash App, Chime, Venmo, SoFi, Robinhood, Mogo, right? And then you can look at each one of these and you can see that there's pretty much, a solution for every single place around the world. And this is only growing. And it also gives you an idea that, like something like Robinhood has potential to grow here or there or over here. Asia, it has the same thing. I mean, Alipay could possibly go to Australia or maybe to Europe or to Africa, right? So all of this is an ecosystem. And whatever market you're deciding to invest in, this is just something to pay attention to. So next, we have in the US, digital wallet users are surpassing the number of deposit account holders at the largest financial institutions. Like if you look here, JP Morgan deposit accounts, the biggest online, traditional way of banking is being beat out by Cash App and Venmo at a crazy pace. I mean, really, they weren't around before 2010. And then 2012, 2014, you have both apps really start to get a foothold on the market at all, right? And then it starts to scale faster and faster. And then within 2 to 4 years, right here in 2017, you can see that it's already getting to a level where, JP Morgan was at 30 years into their platform, at least from when they had their biggest growth, right? This is when they experienced insane amounts of growth, is in this period here. Then they had one more big leg up here back in 2008, 2009. People started to save money, right? They wanted to open bank accounts instead of stuffing their cash under their mattress. But I think it's moving into Cash App and Venmo. And I don't just think, you can see it on a chart right here. You were talking about Venmo and Cash App surpassing in annual active users, by millions. And already, as you can see, Venmo in tens of millions, which is absolutely incredible to see. Next, digital wallets can acquire customers for a fraction of banks' customer acquisition costs. This is very true. They can just be like, hey, you want to use our product? We'll give you $5. We'll give you $10. But for credit cards, it could be as low as $250 all the way up to $1,500. Same thing with bank retail checking accounts, brokerage platforms, insurance platforms, consumer lending. But, Venmo, Cash App, it's easy to use. You already want to switch, and we'll give you $20. How does that sound? And of course, a lot of people decide to go with their platform. So bank branch costs are rising while their utility is decreasing. This is very true. This is just something that you don't even need to see on a chart, but they do have something here, occupancy expenses per bank branch in the US. And that's why brick and mortar stores are really hurting this industry, is because the costs are going up and people don't want to go into a branch. And yet, there's more and more branches being opened up every single day. So this is just something that's very, very crucial when we're thinking about the competition, moving back into the direction of, traditional. I don't think it's going there, especially if, this is the trend that we're seeing. So another important factor is traditional banks are facing potentially sizable risks. The fact that digital wallets are entering the unsecured lending market is suggesting that traditional bank lending is unlikely to recover to the peak hit in 2019. And according to ARC's estimates, bank interest income on credit cards fell more than 10%, or roughly $16 billion in 2020, and is unlikely to drop more than 25% further, from $130 billion in 2019 to $95 billion by 2025. Digital lenders such as Square, PayPal, Affirm, Klarna, et cetera, are likely to take share from traditional banks. This is super true, especially if they can offer rates that are comparable to banks, if not better. I think they can offer better. Maybe not right now, but definitely in the future. At maturity, each digital wallet user could be worth roughly $20,000. They say that potential value per average digital wallet customer across commercial and financial products in the US is going up, right? You see here, we're going to be reaching $20,000 in total value per customer. And if digital wallets were to become consumer financial dashboards, ARC estimates that the net present value associated with their financial service revenues will exceed $10,000 per average US user. And beyond financial services, digital wallets could become lead generation platforms for offline and online commerce, potentially adding $9,000 to $10,000 to their net present value of their revenues. And obviously selling people's data, using it for advertising, Facebook, Google, those companies have been showing that it's definitely valuable. So I think it could be more on this side of things as well. So according to ARK's research, if each of the estimated 230 million US digital wallet users were valued at 19 or 20,000 in 2025, the US digital wallet opportunity would be worth 4.6 trillion. And honestly, the growth of digital wallets is also growing. So I mean, obviously they're probably taking that into account, but that's just something that you have to keep in mind as well. So very, very interesting. Very interesting. So here we go. Bitcoin's fundamentals. The price of Bitcoin has hit an all-time high, supported by robust network fundamentals. And we've actually seen one of these every 3 to 4 years. And so this will kind of talk about where we're headed. So as support for its network increased, Bitcoin's price hit an all-time high in late 2020. Here it is on the chart. December of 2020 hit an all-time high, and it's actually hit an all-time high again when I'm making this video. And Bitcoin's market participants never have been more long-term focused, really, even comparative to like Tesla. I think Bitcoin bulls are a lot more long-term focused. As of November 2020, roughly 60% of Bitcoin supply had not moved in more than a year, a testament to the market's longer-term focus and a holder base with stronger conviction. I think I see this in a lot of really, really bullish stocks. I mean, Google, Apple, Microsoft, Tesla, probably Palantir in the next year or two, and definitely Bitcoin. And even Ethereum is becoming one of those plays. Now, ARK actually doesn't hold Ethereum because they are an institution and they believe that there's a lot more potential in Bitcoin, but that doesn't mean that they're not exploring the option of being able to get into Ethereum, especially if we see an ETF launch. We just saw 2 ETFs launch in Canada, so that might be something interesting to look into. So here we have a chart of the percentage of Bitcoin's supply held for more than a year. You can see a big majority here, and the percentage of Bitcoin supply held for less than a year. You can see that here as well. And this goes all the way from 2010 to 2020. Very, very interesting, and you can see the color coding here. So the dark is 5 years plus, the gray is 3 to 5 years, the blue is 2 to 3 years, the yellow is 1 to 2 years. So I'm personally considered a gray because I've been holding it for roughly since 2016 and 2017. So you consider me a 4 to 5 year, so gray, but there are people out there that have been holding for a lot longer, and these guys are probably the richest folk out there, the people that have been holding for more than 5 years, as long as they bought a decent chunk. If they if they bought half a Bitcoin or a couple cents of a Bitcoin, it's not going to make a big difference, even though it might be thousands of dollars now. So Bitcoin's market and investor set appear to be maturing. Bitcoin's realized capitalization, a measure of a holder's cost basis, has hit an all-time high. A growing cost basis suggests that early investors are taking profits while newer investors are establishing positions and creating higher price support levels. This is actually really, really good. And so here is a graph of market capitalization, and the purple here is the realized capitalization cost basis. So as you can see, that is going up. That is what we want to see long term. Compared to 2017, the hype around Bitcoin appears contained. Bitcoin's search interest is low relative to the increase in its price, as its price neared all-time highs. Bitcoin's Google search interest was at 15% of its all-time high. So here we have the Bitcoin price search volume right here, and the BTC price, and that is right here as well. And as you can see, back in 2018, huge, or really end of 2017, but beginning of 2018, huge price increase at the same time as the Bitcoin price search volume. Now, if you look here, that's gone down dramatically. Meanwhile, Bitcoin's price has slowly started to go back up, and it's actually back into the new all-time highs. If we were to look now, we would be looking at around $60,000 per Bitcoin. Next, we have Bitcoin's increasing acceptance has set the stage for Ethereum and a new wave of financial experimentation. Again, this is what I'm talking about. I think Ethereum is probably really going to be the usability behind blockchain and crypto technology. That's my personal belief, and that's a lot of people's belief. And it doesn't have to be just Ethereum. I think the actual way that Ethereum works, and there's other platforms like it, like Neo is a great example in the Chinese market, that is doing exactly that. It's becoming a more use-based coin or blockchain versus something like Bitcoin, which is just a store of wealth. So they believe that decentralized finance, or DeFi, has been a positive catalyst for the increased adoption of Ethereum's network. By leveraging Ether as trust minimized collateral, market participants can disintermediate traditional financial companies and access financial services like credit and lending, market making, trading, custody, investing, and access to synthetic US dollar exposure. So here you have the purple, which is stablecoin market capitalization on Ethereum, and the aqua blue type color, total Ethereum value locked in DeFi. So as you can see, that's been going up as well. And the more we see that, the closer we get to more credit and lending, market making, trading, custody, investing, and again, access to synthetic US dollar exposure. So this goes up, and you'll see more financial services come onto the market due to Ethereum and other platforms like it. So finally, seizing the opportunity, Bitcoin could play a pivotal role as corporate cash. So here is the hypothetical price increase if Bitcoin were to replace cash on S&P 500 corporate balance sheets. So we can see 0.10%, 1% and 10%, and we would see the potential price increase per Bitcoin. The 10%, if corporations really adopted Bitcoin on their balance sheets of 10%, we would see a 400,000 or 450,000 Bitcoin, right in between there. That would be absolutely incredible, and a lot of people have talked about a $1 million Bitcoin. That would probably take not just the S&P 500, but really all international stocks to adopt Bitcoin. I don't think it would be close to 10%. I think it needs to be closer to 5, maybe 6%. Again, you probably have to take a look at that data yourself because it's not on here. I'm just kind of guesstimating. But again, the S&P 500 corporate balance sheets, if they were to all adopt Bitcoin 10%, we would see this price. And they say here, according to our research, if all S&P 500 companies were to allocate just 1% of their cash to Bitcoin, its price could increase by approximately $40,000. And again, we're talking from that $20,000. This has already happened. And obviously, this is not due to all the companies out there that are adopting Bitcoin. This is just a select few, like Tesla, like Visa, right? And maybe PayPal and Square, but really there's a lot more to come. And I think because those companies were first to get into blockchain, I think that they will increase past the 10% zone if other companies start to enter as 1%, 2%, 3%. So we might see this price of Bitcoin a lot faster than some bulls might think. The biggest thing that we want to remember is that most corporations haven't entered Bitcoin yet, and that is what we want to look for, because that will be the biggest swarm of money into Bitcoin we've ever seen in the history of blockchain technology. That will be very, very exciting. So number 6, Bitcoin preparing for institutions. ARK believes Bitcoin's rapid growth has positioned it for an allocation and investment portfolios. They believe that Bitcoin offers one of the most compelling risk-reward profiles among assets. As our analysis suggests, it could scale from roughly $500 billion to all the way to possibly even $5 trillion in network capitalization during the next 5 to 10 years. We've actually seen a $1 trillion Bitcoin already. So that's already happened. This is very, very bullish, right? They're saying that this could happen in the next 1 to possibly 3 bull runs. In our view, capital allocators should consider the opportunity cost of ignoring Bitcoin as part of a new asset class. So what they're pretty much saying is if you don't invest, consider that a very, very big loss. You know about it at this point, but this could be a big hindrance in your growth if you don't invest. If you do, then you're on the winning side of innovation. So here we go. Bitcoin continues to gain credibility. Regulators, here's some market validation over here, banks as well, institutional investors. I'm not going to read each one because there's a lot of bullet points here and public companies. But if you want, if you're driving in the car, you can go ahead and pause the video right here and then, or take a snapshot of it real quick. And that way you can take a look at this later on. But essentially, regulators, banks, institutional investors, and public companies have all slowly start to adopt Bitcoin. So that is their credibility going up, and that means the price of Bitcoin is going to be going up as well. So next, ARK believes Bitcoin deserves a strategic allocation in institutional portfolios. Untethered from traditional rules and regulations and generally uncorrelated to the behavior of other asset classes, Bitcoin seems to have earned a strategic allocation in well-diversified portfolios. During the past decade, Bitcoin is the only major asset with consistently low correlations to traditional asset classes. This is a really interesting metric to look at. Again, same thing. I don't think that me breaking this down is going to be very well delivered over audio. But again, if you guys want to take a snapshot of this, what it is pretty much shows the correlation correlation between Bitcoin and other asset classes like S&P 500, bonds, gold, oil, emerging market currencies, real estate, Tesla, Apple, BAC, so a bunch of different stuff. And as you can see here, if you want to take a snapshot of this real quick and then take a look at it later when you have a little bit more time, it's going to show that Bitcoin is going to have the lowest correlation between other asset classes. What this means is if something were to happen to, the overall broad market, to gold, to oil, to Tesla, to Apple, to real estate in general, Bitcoin would probably be unaffected by those because it has its own market. So that is really all this is showing. That's actually a really, really good sign if you're thinking about hedging a bet, against real estate, or if you're, big into gold or bonds or the S&P 500, Bitcoin is a really good hedge for you. This is pretty much all that this is saying. Next, Bitcoin trading volume is comparable to that of a large cap stock and has grown at an exponential rate. ARK estimates that Bitcoin's daily trading volume could exceed the volume of the US equity market in fewer than 4 years, less than one Bitcoin cycle or crypto cycle in general, and the volume of the global FX spot market in fewer than 6 years. Holy cow. So here we have another chart, Bitcoin spot market, US dollar daily volume on major exchanges. And as you can see, the trend line is moving up. Look at the Square's average volume has already beat that. Apple's average volume, it's going to eventually beat that. I think we've already beaten that, honestly, now that we are sitting in 2021. But to reach the global US equity volume and to reach the, overall the Forex spot market volume would be an absolutely monstrous feet, and we'll just have to wait and see if that happens. They say in 6 years. We'll just have to wait and see how that trend line is faring in the future. Next, institutional investors can access Bitcoin in sophisticated ways. This is very, very true. Bitcoin open interest, or the total outstanding value of futures contracts, hit an all-time high on the Chicago Mercantile Exchange in October of 2020. It increased tenfold and it hit nearly $1 billion in 2020. Integrated into established financial infrastructures, the CME allows investors of all risk appetites to gain exposure. Not only that, but we've had more and more exchanges that allow you to buy and sell Bitcoin. And not just Bitcoin in general, but cryptocurrencies as a whole. This is really good to see. And the easier that this becomes for the consumers and retail investors, and actually even institutional investors, this will be huge, huge, huge for not just the price of Bitcoin, but the cryptocurrency market in general. Again, another chart for you guys. If you want to take a snapshot of that, go ahead, save it in your phone and something to look back on. So next we believe Bitcoin has earned an allocation in well-diversified portfolios. And really, I think ARK is the first one to kind of realize that. And obviously other companies have followed suit. Square and PayPal and Tesla, right? They've already diversified as well. Based on daily returns across asset classes during the past 10 years, our analysis suggests that allocating to Bitcoin should range from 2.55% when minimizing volatility to 6.55% when maximizing returns. In ARK's analysis, we ran a Monte Carlo simulation of 1 million portfolios composed of various asset classes as shown in the chart. The efficient frontier captures the highest returns possible for a given level of volatility. The stars indicate allocations associated with the maximum Sharpe ratio and minimum volatility. It essentially belongs in every single person's portfolio, especially if you're well diversified already. You might as well throw some Bitcoin in there. Next, we have seizing the opportunity for Bitcoin, and institutional investment could have a substantial impact on Bitcoin's price. What they're saying is the more institutions that come in, the more that the price of Bitcoin will grow. And again, not just Bitcoin, but very, very well-established cryptocurrencies as a whole. I don't want to leave Ethereum in the dust because I think there's a massive, massive opportunity there as well. So here's a hypothetical chart of the impact of institutional investment on the price of Bitcoin. Again, 1% allocation, we probably see close to $100,000 increase per Bitcoin. So we probably see about $100,000 Bitcoin. 2.55% allocation, this is minimum volatility. We're looking at 200,000 plus Bitcoin. And then here we have 6.55% allocation, maximum Sharpe ratio. This is at the very, very peak. We're talking about sovereign wealth funds coming in, insurance companies coming in, pension funds, mass affluent, and the HNWI, which is just high net worth individuals as a whole. So here we have an increase of 500,000%. So that means we would have an increase of over $500,000 in the price of Bitcoin. And we've already, from the time that this was made, increased in almost $40,000. So we're starting to see the 1% allocation come to fruition. Again, in the next few years, we'll probably see 2.55. And in the next 6 to 12 years, we'll probably see this right here. And based on ARK's simulated portfolio allocation, institutional allocations between 2.5 and 6.5% could impact price by $200 to $500,000. So if you think about it from today's perspective, if Bitcoin's sitting around 50 to 60,000, we could already see, a 3, 4, 5x in Bitcoin's price, if not almost a 10x if you're going from 50 to 500,000 in the next 6 to 12 years. This is, again, just an assumption. This is all hypothetical, not investment advice by any means. This is just the data that ARK is finding. Next, we have electric vehicles. This is super exciting. This is number 7. EV sales should accelerate significantly. Electric vehicles are approaching sticker price parity with gas-powered cars. This is huge. And Tesla, being the kind of favorite in the EV space as of right now, is even thinking about launching a $20-something thousand car. So leaders in the EV market are developing innovative battery designs to enable longer range vehicles at lower cost. This is already true. Tesla's working on their own. There's solid-state batteries that are being worked on right now, and a lot of different batteries in between as well. So based on Wright's Law, ARK forecasts that EV sales should increase roughly 20-fold from about 2.2 million in 2020 to 40 million units by 2025. So that is a 20x increase in just 5 years' time. We believe the biggest downside risk to our forecast is whether traditional automakers can transition successfully to electric and autonomous vehicles. I think it's already happening. I think we're on the precipice of the biggest shift from gas-powered cars to electric vehicles. And not just me, ARK believes that as well. Electric vehicle sales have taken share in good times and tough times. While sales of gas-powered vehicles decreased during the recent COVID-19 pandemic, EV sales continued to increase globally. So here we have gas-powered cars, -4%, electric up 16%. This is in 2019. And then -15% year-over-year growth from 2019 to 2020 of gas-powered cars, so -15 there, and an increase from 16% to 33% in the electric space from 2019 to 2020. So this has been a huge wake-up call for people. And again, a lot of people were thinking that car sales were going to go down during the COVID pandemic. And if you live in the United States, a lot of car dealerships were actually able to run promotions. They saw these numbers slipping, so they wanted to get people in the door and buy gas-powered cars. And even their promotions, like 0% financing for 72 months, things like that, did not help the actual sales of gas-powered cars. We still saw a steeper decline this year to year, and we saw an increase in EV sales. And they weren't running the same promotions. I know for a fact Tesla wasn't running any kind of crazy promotion like that. So next, Wright's Law has modeled the decline in battery costs successfully. According to Wright's Law, for every cumulative doubling of units produced, battery cells costs will fall by about 28%. The largest cost component of an EV is its battery, so these cost declines are critical to reaching price parity with gas-powered vehicles. So here's the modeled cost decline, here's the forecast cost decline, and these are the reported prices in between. You can see that it's pretty on point. We will just have to wait and see how these things pan out as more cars are produced. So take a snapshot of this if you want to. Next, we will move on to another chart here that I think you guys will find really interesting. Electric vehicles are approaching sticker price parity with gas-powered cars. This is something that we've talked about on the channel a little bit before. And again, if you haven't subscribed, make sure you smash the subscribe button and also like this video to see more content like this. So the total cost of ownership for a like-for-like EV dropped below that of a Toyota Camry in 2019. Soon, sticker prices likely will do the same. So here we have vehicle prices. On the left, the Toyota Camry, and on the right, 350-mile range EV. So before in 2019, it was $24,000 for the Toyota Camry and $50,000 for the 350-mile range EV. 2021, you can see that the price has already changed quite drastically. $39,000 for the 350-mile EV and $25,000 for Toyota Camry. They believe that 2023 is going to be a lot different, 26 to 26, and 2025 is when we will see the radical shift from the Toyota Camry being $26,000 and the EV being well priced under that at $18,000. So very, very fascinating if you can do the math there. They're saying that in 5, maybe even 4 years time, that the Toyota Camry, which is one of the most sold cars, the Toyota company as a whole is really recognized as like the biggest hot cake seller of gas-powered cars in the world. And they're saying that the 350-mile EV is going to surpass that in reduced cost due to the lowering cost of EV batteries. So in addition to cost, EVs are competing on range and performance. This is a no-brainer. I roll up in my Tesla Model Y and I smoke most any other car besides another Tesla or, a supercar. But, 0 to 60 or even, 0 to 100, it absolutely crushes. And that is one of the slowest Teslas out there. We're talking much slower than the Tesla Model 3 performance. We're talking a lot slower than the P100D of the Model S as well. So the auto market is undergoing a shift to both electric and autonomous. ARC believes that traditional automakers lack the software and electrical engineering talent necessary to succeed. So here we have the 0 to 60 acceleration in seconds on the bottom and the EPA range per kilowatt hour on the top. As you can see, the Tesla Model 3 are all on the top here. And on the left side, the very far left, where, very, very slow, but very good range is the Hyundai, which is right up where the Tesla Model 3 is. And the 2015 Nissan Leaf is kind of up there, but in reality, the Tesla Model 3 just absolutely crushes. And so that leads me into talking about today's battery prices. Cell-to-vehicle technology enables longer range EVs at lower prices. Here is just a very, very simple understanding of how most EVs are manufactured. And then you will see down here battery as percent of volumetric density. And on the bottom right, you'll see how leaders in the space are manufacturing EVs. This is cell to battery pack per vehicle. So very, very interesting infographic there. And just to give you a quick rundown, cell to vehicle designs increase the volumetric density of batteries by 50% relative to battery cells integrated into modules and packs. In the mass market segment, cell-to-vehicle technology should enable EV makers to lower energy density and cost, cells producing more kilowatt hours to increase the range of vehicles. At a given battery pack size, cell-to-vehicle technology should enable longer range vehicles at lower price points. That's why when we talk about the Cybertruck, which is just a year away, we're talking a much, much better battery, and we're talking about a lot more range and really bang for its buck as far as, the speed goes. And not to take away from the aerodynamics of the car as well, because that does play a factor, but we're just talking about batteries in general. And this is absolutely insane at where we are going. And a lot of that has to do with Wright's Law. So next we have seizing the opportunity of electric vehicles. If traditional automakers overcome obstacles, global EV sales could scale roughly 20-fold from 2.2 million cars, in 2020 to 40 million by 2025. Look at this jump. And again, they are filling in for the few years here in between, right? As you can see, but we've already had a pretty good scale here up until 2020, but it's only gonna get crazier because a lot of people that maybe have older cars are going to be switching to different kinds of EVs because it just makes sense. As the prices come down, that's going to play a big factor. Regulation will play a big factor, and the fact that a lot of traditional car manufacturers are switching to EVs, all those things will play a huge factor in the growth that we're seeing here. So it's not just battery technology that's going to get cheaper. There's a lot more things to think about, and that is where this data comes from. So that leads me into automation. Let's talk about number 8, which is automation. The robots are coming to help you and create more jobs. Fears about that automation will destroy jobs, but ARC believes it will empower humans, increasing both productivity and wage growth. Automation has the potential to shift unpaid labor to paid labor. For example, as food services automate, they will transform food prep, cleanup, and grocery shopping into market activities, including food delivery. ARC believes automation will add 5% or $1.2 trillion to US GDP during the next 5 years. So let's talk about it. The US economy is at automation levels similar to that of US manufacturing in the early 1990s. So what we saw in the 1990s of manufacturing, we're about to see in the next 5 years in automation. While manufacturing took roughly 25 years to hit its current level of automation, ARC believes that the US economy will automate at a rate 5 times faster during the next 5 years. And the industrial robot demand seems to have hit an inflection point. So following the Great Recession in 2008-2009, perhaps in response to it, industrial robot demand hit an inflection point. Trade tensions between the US and China may have added to the momentum before COVID-19 created a headwind in 2020. According to ARC's research, short-term obstacles will not prevent a rebound in industrial robot sales and could encourage companies to automate and cut costs more aggressively. So here you have a little chart, industrial robot price elasticity of demand. So from 1996 to 2002 is the purple down here. The 2002 to 2010 is the green down here. And then the 2009 and 2019 is this very, very low point, which is pretty much back to these levels of, 1996 to 2002. And then we have right here 2010 to 2015, which has been absolutely rapid. And then from 2016 to 2018 has been also growing exponentially. They show 2019 here, but I would be really interested to see 2020 and 2021 figures come up to here of the unit sales of industrial robots. This is already in play. I believe that this number is going to be really, really high, and we'll just have to wait and see what these numbers turn out to be. Regardless, we're already at a really, really crazy pace for beating the unit sales of these industrial robots all the way back here. And remember that these are also the unit price of an industrial robot. So while the prices are going down, the amount sold has been going up. So that is very, very powerful and very, very interesting to look at. Increased automation and productivity can provide many economic benefits. So this is touching on the point that a lot of people think, well, isn't it going to remove jobs, right? Isn't it going to hurt our labor force? So a drop in labor relative to capital does not suggest necessarily that wages are falling. Instead, output can grow faster than wages. Thanks to increased productivity and automation, ARK expects a combination of the following four outcomes: higher wages, benefiting employees; lower prices, benefiting consumers; higher margins, benefiting companies; and or higher investments, creating virtuous cycles. So here we have a little chart, US manufacturing robot density versus US manufacturing labor share. So labor share of US manufacturing has been going down percentage, and then US manufacturing robot density per 10,000 employees has also been going up. And this is in the time frame between 1991 and 2015. If you want to take a snapshot of that, here is your chance. And let us move on to the next one. Historically, when labor share has declined, operating margins have increased. So according to ARK's research, for every percentage drop in labor share in the industrial and agricultural sectors, operating margins increased 30 basis points and 280 basis points respectively. We would not be surprised to see a similar relationship in all industries. If labor share were to fall 15% in line with manufacturing, operating margins could double to more than 20%. So here we have labor share on the bottom. So this is going from 65 to 60 to 55 to 50 to 45 to 40%. And then operating margin on the left-hand side from 0 to 5 to 10, 15 to 20 to 25%. Here is their forecast, which is the purple dotted line, and the historical aggregate data from the S&P 500 operating profit margins versus all industries labor share. So this is just the historic data. And again, this is just the forecast is showing based off of that data. Pretty interesting, and again, just something that we need to pay attention to if you really want to understand what automation will bring in the labor force. Automation shifts unpaid labor into paid labor. So paid versus unpaid farm workers. Here are two charts. I'm not even going to read this because I think this is going to bring you the most amount of value here. Paid versus unpaid farm workers. Paid workers is this purple down here. So this is 1950. 2.3 million workers were the amount of paid workers, right? And then 7.6 million were the unpaid family workers back in 1950. Now in 2000, both numbers have actually decreased. 1.1 million have been paid workers and 2.1 million have been unpaid family workers. But which one decreased the most? Well, this one went in half, right? The paid workers pretty much dropped in half from a time frame of 50 years. Meanwhile, the unpaid family workers has dropped almost fourfold at the same time. And then employed persons in the US went from 1950 of 59 million to 137 million in that same time frame. So remember that the loss of jobs in one industry, even a major industry, does not suggest that total employment will decline. This can be seen in farm workers. And again, this is not to take into account that, this will apply to every single industry, but that is what ARK suggests. So seizing the opportunity in automation. Automation could add 5% or $1.2 trillion to US GDP during the next 5 years. ARK believes automation will boost US real GDP growth by 100 basis points on average per year to 3.4%. So GDP growth without automation on the left, and then GDP growth with automation on the right over the next 5 years' time. So next we have autonomous ride hailing. Autonomous ride hailing is likely to dominate urban transport. We believe autonomous ride hailing will reduce the cost of mobility to 1/10 the average cost of a taxi today. Oh my Jeebus. 1/10 the average cost of a taxi. So you remember taking at 12 o'clock, taking that Uber ride from downtown to your home and cost like $50. ARK believes that that cost would go down from $50 all the way to $5, a tenth of the average cost, spurring widespread adoption, of course. ARK's research suggests that autonomous ride-hailing platforms will generate more than $1 trillion in profits per year by 2030. In addition, automakers and fleet owners could enjoy profits of $250 billion and $70 billion respectively. Wow, this makes me want to own a lot of autonomous taxis. So autonomous ride hailing is likely to be affordable. Adjusted for inflation, the cost to own and operate a personal car has not changed since the Model T rolled off of the first assembly line. ARK estimates that at scale, autonomous taxis will cost consumers 0.25 cents per mile, spurring widespread adoption. So a quarter per mile in 2025 is what they're saying would essentially cost to operate one of these vehicles. So that is why they say that the profits would be so big, and why people would choose them over an Uber or a Lyft, unless of course Uber and Lyft can adopt that change. So robotaxis should expand the ride-hailing market. According to ARK's research, the ride-hailing market today generates roughly $150 billion in revenues globally, with take rates of 10 to 30% and profit margins as high as 50% in high-performing cities. Likewise, autonomous ride-hailing could generate 50% margins, but its lower price point should expand the total market from $150 billion in revenues with take rates of up to 60% to $6 to $7 trillion by 2030. So here you have a little chart, economics of ride-hailing versus autonomous ride-hailing. So you have on the left side ride-hailing 2020 and on the right autonomous ride-hailing. And you can see the profit margins, the platform cost, and the price per mile for a consumer is around $1.85. On the other hand, over here, they say over here that the profit is about the same, 25 cents versus 28 cents. Not that big of a difference. And you, again, not having to work because the autonomous car is doing all the work. The platform cost is about the same. Probably, I would say it might increase, but they say it might even go down slightly. And then price per mile for a consumer is around $1 versus $1.85. And in the long term, that is the big winner, because if the price per mile goes down for the consumer, then you will have massive adoption. And if the profits can stay the same, that will also be a very, very big play when you are thinking about mass adoption from one industry sector to another. This will pretty much be its own sector. So this is super exciting. 3 autonomous strategies are evolving. So here is the camera-based strategy, the LiDAR and HD map strategy, and the V2X strategy. And the respective companies behind these is Tesla, Waymo, and Apollo. Now, Tesla's approach is camera-based. With less accurate sensors than LiDAR making the path to full autonomy a more difficult problem to solve, cameras do not rely on HD maps and should enable a much more scalable service. Tesla's could be the first autonomous taxi network to scale nationally. Alphabet's Waymo, meaning Google's company, if you guys haven't heard of it, is using LiDAR and HD mapping. Waymo launched its autonomous network in Arizona, but probably will need more time and significant resources to scale nationally. Now, many Chinese players, including Baidu's Apollo, which I believe in Baidu. If you guys want to see a full video on that, I'd love to make a video on that company, are building out infrastructure sensors to help vehicles identify road signs and traffic, requiring large infrastructure investments. This approach to autonomous ride-hailing seems to be the most rigid and least scalable of the 3. So you can see solution speed. So from perceiving and localizing, LiDAR, HD maps, and V2X is actually really, really easy. Where it gets a little bit more challenging for all 3, including camera-based Tesla, is actually predicting. So Tesla has the hardest time predicting. LiDAR and HD maps actually has the easiest time, and V2X is starting to get more and more difficult. Now, driving, this is where Tesla starts to become easier and easier. Tesla's got driving down to a T, and they say the solution speed is medium, as you can see up here. And for LiDAR's case, it's actually, a little bit better still. It's a little bit faster, but it's starting to slow down. And V2X, it's slowing down dramatically here. And then deciding is where V2X fails, right? It's very, very slow to adopt. LiDAR and HD maps is actually medium solution speed, and camera-based is actually really, really easy. It's kind of going backwards here. And so Tesla is flexible, scalable. It's also far ahead of the competition. Waymo is up there with Tesla, and then V2X or Apollo's V2X is probably the slowest. Doesn't mean that it's not going to happen. And again, this is just a prediction, but a very good one at that. And so next we have is scalability, and that will determine the pace of autonomous ride-hailing adoption. If Tesla launches its autonomous ride-hailing service successfully in 2022, which is really just 1 year away for us, if you're watching this in the future, congratulations, you know the future, and we didn't. ARK estimates adoption could approach 20% by 2025. If Waymo or GM is successful, adoption will probably be limited to 1% during the next 5 years. This has a lot to do with regulation and legislation, but we will just have to see what will happen. Here we have a chart of North America autonomous vehicle adoption as a percent of urban miles traveled. Tesla has done the most, so they are projected to do the best. ARK forecast is somewhere in the middle, and then Waymo adoption is projected to grow at a steady pace. Very, very low, but steady nonetheless. And so here we have the percentages on the left, and then on the right here is the time frames. So again, if you want to take a snapshot, here is your chance. Next, demand response could be higher in developed versus developing countries. We believe autonomous ride-hailing will undercut the cost of human-driven ride-hailing by roughly 90% in the US and 50% in China. As a result, the demand response to inexpensive autonomous travel could be higher in developed countries than in developing countries. Platform providers or companies that own the autonomous technology stack should garner the lion's share of autonomous ride-hailing profits. So on the left here you have Didi, and on the right here you have Uber, and this is a chart showing human ride-hailing versus autonomous ride-hailing. Average price per mile in China versus the US. Human is on purple, and autonomous ride-hail is in this lime green color here. So you have 0.5 cents for human, for Didi, and then a 50% decrease for the autonomous, right? And for Uber, it's even more dramatic. Human ride-hailing right now is $2 for Uber, and for it to go to autonomous, it would drop 88% all the way down to 25 cents as well. Very, very interesting. Lastly, on autonomous vehicles here, we have ARK believes that autonomous ride-hailing / taxi networks could generate more than $1 trillion in operating earnings annually by 2030. Here we have the chart. Here we have the chart in 2025 and 2030. This is purple platform provider, green auto manufacturer, and black is the fleet owner. We have $190 billion by 2025 for the platform provider. We have the auto manufacturer making $40 billion in 2025, and we have the fleet owner making $5 billion as well. And then the platform provider in 2030 is going to grow from $190 billion to $1,200 billion, so $1.2 trillion. And then the auto manufacturers also multiplying by a huge denomination to $250 billion. And then the fleet owner goes from $5 billion in 2025 to $70 billion in 2030. Again, these values are rounded, but just something to keep in mind. Okay, so let's talk about drone delivery. Now, drones should reduce the cost to transport goods and people dramatically. That is why I'm personally starting to invest heavily into drone delivery technology, because the biggest thing stopping it, in my opinion, is regulation, right? So lower battery costs and autonomous technology should power aerial drones. ARK believes that in the not too distant future, drones will deliver our packages, food, and even people quicker and more conveniently than ever before. Drones are likely to transform shopping behavior, reduce travel time, and save lives. ARK believes that drone delivery platforms will generate roughly $275 billion, that's with a B, in delivery revenues, $50 billion in hardware sales, and $12 billion in mapping revenue by 2030. Autonomous air travel has become possible and affordable. Now, battery technology is improving enough so that flight energy reserves can meet regulations, enabling air taxis and air ambulances to take to the skies safely. In addition, machine learning improvements have enabled autonomous flight, reducing costs dramatically. So on the left here, you have the safe passenger drone range, inclusive of flight reserved for safety, right? So this is in miles on the left. On the bottom, you have the time frames. So this is from, 2000 and really to 2014. It didn't, we didn't have anything, right? The purple line is just null. And as of 2020, batteries accommodated 12-mile flights with necessary reserves. So this is the distance from Manhattan to JFK. Here we have 2020. And I think as we move into 2021, it's only going to get better. And that has a lot to do with just the way that battery technology is going. And obviously, if you watched the whole video, you probably remember the battery conversation that we had earlier. So cost of a 10-mile drone delivery, if it was remotely piloted, is $7.80. Autonomous, only 25 cents. And this is 10-mile drone delivery. So one of the biggest companies that I personally like for this is Workhorse. Now they do have some working demos if you want to go check them out. There's obviously other players in this space, but that's just a company that I've been personally starting to buy up shares as they have been downtrending as of late. Now, drones enable cost savings and convenience. In the past 2 years, the Federal Aviation Authority, or the FAA, has kickstarted the commercial drone industry by allowing companies to operate drones beyond line of sight, and in some cases, to operate drone airlines. Florida is building the first U.S. passenger drone vertiport with plans to operate in 2025. Here we have the drone delivery costs at scale relative to competitor costs today. You can see pharmaceutical delivery and pickup, Orlando to Tampa, bridge inspection, and parcel delivery. You guys can take a snapshot of this. I don't want to talk about each one because that will take probably 10 minutes just to analyze each one and explain each one in full detail. But if you want to take a snapshot of this and take a look at each one, I think that will give you a good idea. Or if you have a second, take a look at the screen now. I'll give you guys a second to take a look at it. But next, we're going to talk about the fact that drones could deliver a substantial share of e-commerce shipments by 2030. We know that e-commerce is absolutely huge, not just in the United States, but around the world. So this would be a big impact to this industry. COVID-19 accelerated e-commerce experimentation and adoption with contactless drone deliveries. ARC estimates that at some point during the next 5 years, drones will deliver more than 20% of parcel shipments. If that is true, that is absolutely huge for e-commerce and even more importantly for drone technology and companies that are involved in this space. Global e-commerce shares of retail with drones. Here we have the chart 2020, 2025, and 2030. You can see here the black is the e-commerce or non-drone, 18% in 2020, and rest of retail is 82%. Now 2025, we're creeping into the 32% of non-drone. This is the black again, but drone delivered is about 13%. Meanwhile, the rest of retail is about 55%. And they say in 2030 that the fact that non-drone will be around 20%, so it'll probably decrease back down to 2020 levels. Then the 40% will be rest of retail, and then another 40% will be drone delivered. As in 2020, there was less than 1%, it doesn't even show up on the chart here, that is drone delivered. So a big radical change in e-commerce. Now, global parcel drone delivery revenue in billions is set to reach 15 billion in 2025 and 115 billion in 2030. Wowza. Drones should accelerate the shift to food delivery as well. Obviously, with the pandemic and even before then, we've already had a surge in delivery apps. Uber Eats, DoorDash, Postmates, and so many others. Online food delivery sales grew more than 40% globally in 2020. According to ARC's research, drone delivery will account for nearly half of the 40-ish% of food prepared outside of and delivered to the home. So here you have a chart. You can see global food delivery as a share of food away from home. This is 2020 at 2%, food delivery as a percent of food away from home, right? 2025 is 13%, same stat. And then 4% is additional share gain with drones. By 2030, it's almost neck and neck. 22% is going to be food delivered as a food away from home delivery. And then 19% is additional share gain with drones. Global food delivery revenue in 2025 should be around 18 billion. Meanwhile, in 2030, will almost 10x, closer to like 6 and 7x, or $116 billion respectively. Oh my goodness. And of course, we do have to talk about seizing the opportunity. While not yet commercialized, ARC estimates that drone delivery platforms will generate nearly $50 billion in revenues, 14 of which will be in hardware sales and $3 billion in mapping revenues by 2025. By 2030, drone delivery platforms could scale another fourfold, generating $275 billion or so in revenues, while hardware sales grow nearly threefold to almost $50 billion and mapping revenues nearly fourfold to $12 billion. Again, you guys, if you guys want to take a picture of this will give you a visual of those numbers, those facts going forward into the future. If you want to save that for later and just compare, in 3, 4, 5, even maybe 10 years, that'll be very interesting if you want to save that in a folder in your phone. I would do that now. And without any further ado, let's talk about orbital aerospace. The space industry is taking off. Literally, rocket and satellite cost declines are upending what once seemed a monopolistic and bureaucratic industry. And thanks to advancement in deep learning, mobile connectivity, sensors, 3D printing, robotics, costs that have been ballooning for decades are beginning to decline. And you can honestly thank a little bit to Elon Musk there with SpaceX. As a result, the number of satellite launches and rocket landings is proliferating. According to ARC's research, the orbital aerospace opportunity, including satellite connectivity and hypersonic flight, will exceed $370 billion annually. And you can also thank Virgin Galactic and Blue Origin as well. So orbital aerospace is a big idea. Now, global connectivity is something that SpaceX is really hard at work at. Roughly 50% of the global population lacks internet connectivity, but with more satellites, cloud computing will go global. Hypersonic point-to-point travel. As long-haul flight times collapse from 10 plus hours to 2 to 3 hours, the global economy could transform. And Virgin Galactic is planning to do that very soon. They already have a bunch of flights planned. Now, multi-planetary species, humans have been living on the International Space Station for 20 years. Within a decade, humans could inhabit the moon and Mars. Now, of course, there's controversy that we're already on the moon. I don't think that we have a moon base there yet, but I do think that we're working on it on Earth to eventually do the exact same thing on the moon and eventually Mars as well. Next, rocket reusability could lower the cost of launches by an order of magnitude. So this, if you follow along very closely with SpaceX, they have actually flown the same Falcon 9 rocket booster 8 times successfully. In a previous interview, Elon Musk actually mentions, this is back in, I believe, 2012 or 2013, so very long time ago, he interviewed and he mentioned that the magnitude that they're going to be able to reduce the costs of aerospace flight and actual reusability of rockets is going to be 100 times cheaper, just because of the fact that they can reuse the rocket over and over as long as they stop blowing up. No, but really, it's really exciting. And let's talk about lower satellite launch. So lower satellite launch costs could enable continuous global coverage with low latency. This is something that SpaceX is planning to do. While satellites launched into geostationary orbit attempted to offer global coverage, latency limited their ability to provide a compelling broadband internet offering. Today, companies are beginning to launch thousands of satellites in low Earth orbit and enabling continuous global coverage with low latency. And again, you do have to thank SpaceX and the team over there for that. Thanks to lower launch costs, the number of satellites scheduled for orbit has increased significantly. So that's an obvious one because, back in the day, rockets cost a lot of money to send out, and NASA was hoarding cash in order to do more missions like this. But now they might not have to hoard as much cash and are able to distribute that to companies like SpaceX, Blue Origin, and others that are pretty much doing this very thing. So satellites could bolster GDP growth as their networks launch and leverage data for terrestrial businesses. Here is a chart for you guys from 2005. You can see pretty much nothing. I mean, there's been around a couple hundred satellites here, a few thousand here, 2019, 2020, not much has changed, but the ones that are planned is over 25,000 plus active satellites. And I think most of this is, government agencies, but the big majority is actually SpaceX. So seizing the opportunity, satellite broadband revenues could approach $10 billion per year in the US and $40 billion globally during the next 5 to 10 years. According to ARC's research, the $40 billion opportunity to serve populations without access is a fraction of the total addressable market for satellite broadband. The market for connected planes, trains, and motor vehicles is likely to reach $36 billion in 2025. Governments globally are likely to add further to the demand for space services. In total, the satellite connectivity market could approach $100 billion annually over the medium term, not even the long term we're talking about here. So 42 million Americans without access to broadband. Divide that by 2.6 people per household. Times that by $50 average monthly broadband bill over the course of 12 months per year is around 10 billion annual addressable market. And down here, when we're talking about worldwide, 3 billion people globally, divided by 5 people per household, times that by 5 monthly broadband bill, times that by 12 months in a year, that's around 40 billion annual addressable market. And this actually could increase in price, I think, over time as the monthly broadband bill goes up. This could be a 50, 60 billion annual addressable market here. So very, very impressive. And ARK expects the demand for hypersonic flight to skyrocket as well. According to their research, passengers on short-haul flights are willing to pay roughly $15,000 for every 2 hours saved on private planes. Now we're talking about people that are willing to save that much, that have a lot of money. People like you and I probably don't want to spend an extra $15,000 for every 2 hours saved, but the cost of that will go down and down and down. And maybe down the road, it might even equal the same price as a regular plane. And once it gets to that competitiveness, normal planes might start to go out of business. Now we're talking, very, very far away, decades even, but it's definitely possible. So based on the economics of the short-haul flight market, ARK estimates that passenger and business will be willing to pay $100,000 to save 13 hours on a 2 to 3 hour private hypersonic flight from New York City to Japan. If 2.7 million passengers were to pay $100,000 for long-haul hypersonic flights, the market would scale to $270 billion in revenues annually. And again, this is Virgin Galactic's big mission. That's what they want to do. So here's another little bit of a graph. 4.5-ish billion passengers flew in 2018. 15% of those were around 7 hours. 680-ish million passengers flew on flights longer than 7 hours. 2.7 million persons potential annual hypersonic flight addressable market, because it is taking into account that 0.4 of passengers that flew private. And based off that 2.7 million people figure, we're looking at $100,000 per hypersonic flight. That equals to around 270 billion annual in revenue for any company that can properly execute in this market. So there we have orbital aerospace. Next is 3D printing, and this is something that I've been talking about on the channel for quite some time because I believe there's a huge potential in 3D printing. I think in the next 5, 10, 15, maybe 20 years, I think that's a little bit of a stretch, but before 20 years, I think that a lot of people are gonna have 3D printers in their home that are very sustainable, that actually will help you create gadgets, products, things that you wanna have, literally even invention ideas, or hey, you need a fork real quick and you don't wanna run to the store, you can just 3D print a fork. Now, technology right now in the 3D printing space is slow and expensive, but I think as more people adopt it and technology gets cheaper, the prices to have a 3D printer in your home will actually make sense. Just like we have regular printers in the home for papers and copies and maybe making stickers, things like that. It is my personal belief that 3D printers are headed that way for daily use as well. Now let's talk about what ARK believes. 3D printing saves time, cost, and waste while creating radically new part architectures. 3D printing is a form of additive manufacturing that builds object layer by layer as opposed to traditional subtractive manufacturing that removes material from larger blocks. 3D printing collapses the time between design and production, shifts power to designers, and reduces supply chain complexity at a fraction of the cost of traditional manufacturing. ARK believes 3D printing will revolutionize manufacturing, growing at an annual rate of roughly 60% from 12 billion last year to 120 billion in 2025. So a 10x in just 5 years. 3D printing revenues declined in 2020, but new users leveraged the technology during the pandemic. And a lot of this is due to the fact that a lot of companies didn't have the resources to be spending a bunch of money when they're losing a bunch of money during a pandemic that really hit the whole entire world economy. So they're not looking to spend a lot of money on 3D printing, but that doesn't mean that it stopped growing. That's what this presentation shows here. So you can see applications during the COVID-19 crisis, medical devices, personal protective equipment, personal accessories, testing services, training and visualization aids, and emergency dwellings as well. 3D printing sales at public companies, this is in millions, you can see have gone up and up and up. 2019, it actually stayed about the same as 2017. Obviously, 2018 was an absolutely ridiculous year. It looks really, really good. And then you can see 2020, this is in September of 2020 when they pulled this data, it was a little bit lagging. Now, this doesn't mean that it didn't equate to 2019 levels. I think it did, but it would be interesting to see what 2021, 2022 look like post-pandemic. I think that this is a good understanding for you guys to be able to visualize how much companies, 3D printing companies, sales are. And again, this is in the millions. So as you can see, these are some of the biggest players in the game. I'm personally invested in some companies like SSYS, DDDD, and a little smaller one, NNDM. NNDM, as you can see, isn't really showing up on this chart. It's tiny in comparison, but SSYS and DDDD are actually on that list in masses, right? These are the biggest companies that are making the most money in sales. This is good to see, and I think the growth is only just starting, and so does ARK. 3D printing is in its infancy. ARK's research indicates that 3D printing for end-use parts is the next frontier. So as you can see, prototypes, 12.5 billion market potential. Molds and tools, $30 billion market potential. End-use parts, $490 billion, $500 billion market potential. And now the current penetration, well, we already have market potential, 40-50% is the current penetration for this market. 4% is in the molds and tools, but only 1% is in end-use parts. So the scalability here is absolutely dramatically different than what prototypes and molds, even combined, looks like. So 3D printing applications vary by industry volumes and complexity. That's obvious. But where is the addressable opportunity? Well, on this chart here, you can see the 3D printing addressable opportunity. This is again in billions. So when you see on the left side here, 100, 200, 300, 400, that's all in billions. And the top applications, right, by industry is aerospace, automobiles and auto parts / equipment, and machinery. And then it goes up from there. But those are, again, the most addressable opportunities out for 3D printing as of today. And I think this is only going to grow over time. So 3D printing enables many form factors. Because of autonomous technology and battery breakthroughs, aircraft volumes and designs are proliferating. 3D printing is accelerating innovation thanks to low cost and rapid prototyping. It lowers the weight of low volume, highly complex parts, saving significant costs. The aerospace industry should be a prime beneficiary. And ARK estimates that drone hardware revenues will total roughly $100 billion by 2025. Look at all these drones. And I mean, these are just the drones themselves. We're not even talking about landing equipment, anything like that. But again, ARK estimates that the drone hardware revenues will total $100 billion by 2025. It's just absolutely unbelievable because of how early on we are in the drone space, but really how early on we are in the 3D printing space. So 3D printing unlocks the full potential of artificial intelligence in manufacturing. The convergence of 3D printing and artificial intelligence enables highly optimized designs not possible in traditional manufacturing. So U.S. Air Force Institute of Technology, here you have 125 parts into one part, 50% lighter, 20% stiffer, and 6 times reduction in failure locations. Hexar custom helmet insert, 60% more shock absorbent, 25% reduction in rotational force to head, and 45% reduction in rotational velocity to head. And here we have Yamaichi special steel brake caliper. This is 40% lighter, better airflow, and better pressure distribution. Again, this is going to bring manufacturing to a higher standard and typically for a lower cost as well. So seizing the opportunity, ARK believes that the global 3D printing market will scale at a compound annual rate of 60% during the next 5 years, from 12 billion to roughly 120 billion by 2025. And if you wanted to take a look at the global estimates for the 3D printing market from 2020 to 2025, here is what other companies believe. The 2020 date of estimate was 12 billion. Ernst & Young said that by 2023 we'll have 27 billion. By 2024, 3D Hub says 35, 36 billion. When it comes to 2025, Lux Research says, hey, it's going to be $20 billion, which we're really close to that already. And then Smart Tech says 33 billion. BCG says 51. ARK up here is 120. And then McKinsey says anywhere from 120, which is just a copycat from ARK's, I think, and then 180 to 490 billion by 2025. So that gives you a good idea of what's possible. And like I mentioned before in the previous slide, here are the companies that are doing the biggest things. If you want to go check some of them out, here are the ticker symbols for you. You can go ahead and take a picture of that while I have it on the screen. All right, the 13th thing we have here is the long read sequencing. Long read sequencing could provide a more complete picture of the human genome. So we're already going into genomics here. Next generation DNA sequencing, or NGS, is the driving force behind the genomic revolution. Though historically dominated by short read sequencing, we believe long read sequencing will gain share at a rapid rate. ARK believes long read technology offers superior accuracy, more comprehensive variant detection, and a richer set of features than short read platforms. By the end of 2025, highly accurate long and short reading sequencing should approach cost parity, so equal in cost. We estimate that long read revenues will grow 82% at an annual rate from $250 million in 2020 to roughly $5 billion in 2025. The genomic toolkit is expanding to provide a fuller, richer, and more accurate view into biology. So here you have first generation sequencing, then you have second generation, optical mapping, and you have third generation sequencing. And again, here are some companies behind each one. And this will give you a good insight of what, if you're thinking, hey, I think optical mapping is the way to go. Well, you can invest in BNGO. If you think single cell biology is the way to go, then 10x Genomics or Berkeley Lights, right? And if I'm not mistaken, some of these are private companies, but again, just something to look into if you're curious, hey, what are the names that are actually paving the way from, first gen to third gen? Here they are. And I'm actually invested in some of these already. 10x Genomics, I own some of their stock alongside with BNGO. And honestly, if I can get BNGO on a discount, I would buy more of them. Now let's talk about the accuracy, okay? So historically, researchers had to choose between accuracy with SRS or comprehensive with LRS. Now, what's the difference between each one? Again, SRS is short and LRS is long. Okay, so remember that. Both LRS and SRS systems break the genome into smaller fragments, analyze the fragments with high resolution optics, and reassemble the genome with efficient computer algorithms. Now, SRS blends many small fragments called reads into a consensus sequence. This method captures small mutations but does not detect larger reshufflings called structural variants or mutations hidden in repetitive genomic regions. Older LRS systems measure larger reads and, while less accurate on a per base level, provided a more complete picture of the genome. So as costs for LRS converge with SRS, many clinical applications could shift to LRS. Catalyzed by deep learning algorithms such as Google's Deep Variant, both synthesis and nanopore-based LRS methods rapidly could improve in performance. Though less accurate on a per-base level currently, nanopore-based LRS can generate whole human genome sequences for roughly $500 more effectively than SRS. Though more expensive, according to results obtained from the Precision FDA Truth Challenge V2, synthesis-based LRS is 2.5 times more accurate than SRS and 30 times more accurate than nanopore-based LRS. So here is a graph for you guys. This is synthesis-based LRS and SRS could near cost parity by 2025. This is, again, just a log scale in USD. So you can see here 2010, 18 times, 5 times, 3.5 times, and here's the cost base, about the exact same 1 to 2 times more expensive by 2025. So not only is it more effective and accurate, but also it might just get down to the same price as old school SRS. So here we have, according to Wright's Law, for every cumulative doubling in data produced on its installed base, the cost of synthesis-based LRS has declined and will continue to decline by 28%. Driven primarily by improvements in cost and throughput, LRS's unique capabilities should galvanize broader adoption. LRS does not require amplification and will detect methylation natively, and at the same token will span full RNA molecules. According to ARC's estimates, the cost to sequence a whole human genome with long-read technology will drop to $100 to $200. It's accurately superior to SRS across all variant types by the end of 2025. So here you have a graph. You can clearly see this is kind of the path that we're on, and this is $1,000 or less estimated by 2023 for the synthesis-based LRS market. Again, this is just following Wright's Law. And here we have, ARC believes that LRS analysts are superior for many sequencing applications, from pediatric cancers to many rare diseases, to common hereditary diseases, and even studying structural variations in a population across diverse groups. So again, not only is it better, but also it will be relatively cheaper than what it is today. So seizing the opportunity, ARC expects the LRS market to grow at an annual rate of 82% through 2025, from a whopping $250 million in 2020 to $5 billion in 2025. So a huge growth rate potential, and companies that you can buy on a discount, I'm sure, are going to be the ones that pay off in the long term, especially the ones that are already doing this and ahead of their space, right? if you can find the Tesla of the genomic space or the Google, well, Google is in it, so I can't really say Google as one of them. If anything, you could probably invest in Google and achieve the same results. So a very interesting space being genomics, but the long read sequencing is another super, super interesting thing that we should note when we're talking about innovation in that particular space. Next, we have multi-cancer screenings. Liquid biopsies could prevent more cancer deaths than any medical intervention in history. According to ARC's research, the convergence of innovative technologies has pushed the cost of multi-cancer screening down by 20-fold from $30,000 in 2015 to $1,500 today, and it should drop another 80% plus to about $250 in 2025. As a result, the multi-cancer screening market could scale to 150 billion USD. In the US alone, a multi-cancer screening protocol could avert 66,000 cancer deaths per year in the US, saving about 1.4 million human life years. Incredible. So, diagnosed early, cancer can be treated successfully. This has been a tried and true sentiment for a very long time, but it's becoming a bigger reality today. All solid tumors follow a predictable path from local and treatable to metastatic and lethal, providing the rationale for earlier detection. Metastatic cancers comprise just 17% of new cases, but cause 50% of all cancer deaths over a 5-year period. And the weighted average 5-year survival rate for localized cancers is 89%, but only 24% for metastatic cancers. So here you have a chart. Again, this is just putting what I just said on a graph. So I don't think you guys need me to break that down, but if you want to take a snapshot, here you go. So based on a single blood test, multi-cancer screenings can detect dozens of early stage cancers. The combination of innovative technologies is driving down screening costs. So from 2015 over here to 2025, you can see $30,000 was the old screening cost. Then machine learning dropped that to, roughly what it looks like is about $20,000. Deep sequencing, even less. Target capture, even less. Now, 2020 prototype is around $1,500, and the 2025 commercial way to do it is around $250. This is again just ARC's hypotheses, but it's coming to fruition based off of their research. So, thanks to rapidly declining costs, multi-cancer screening is approaching a reimbursable price point. As population scale clinical utility data proliferates, ARC believes a $1,500 price tag will unlock the multi-cancer screening market for those aged 65 to 80, the age range in which the incidence of cancer peaks. As prices drop below $1,000, nearly all age groups above 40 years old could be screened for cancer cost effectively, potentially saving up to 1.4 million human life years in the US alone, not even mentioning the world, right? So here you have the multi-cancer screening market, cost and reimbursement. On the bottom, you have patient's age, and then on the left, you have the incremental cost and life years gained. So obviously, as the tests get cheaper, they fall into this eligible reimbursement / willingness to pay category. And in addition, you're going to save more and more lives doing that. So multi-cancer screening could prevent roughly 66,000 cancer deaths annually in the US. So routine blood-based multi-cancer screenings combined with improvements in single cancer screenings could prevent 40% of metastatic diagnoses and increase loco-regional diagnosis by 10%. Even without improvements in cancer therapy, ARC estimates that earlier intervention could prevent 66,000 cancer deaths per year in the US alone. So earlier detection could lower cancer mortality. Of course, right? That's what we said in the slide before. Motor vehicle deaths, here you have 40,000, narrow panel age 50 to 80, around 60. Broad panel 50 to 80, 64-ish, and then here we have that 66,000 figure for broad panel age 40 to 80. So multi-cancer screenings and other genomic technologies are transforming oncology. So hereditary cancer testing can influence the onset frequency of cancer screenings. Then multi-cancer screenings can detect cancers in early and treatable stages. So single cancer screenings plays a vital role in detecting several forms of cancer. Molecular prognosis testing can help pathologists differentiate between aggressive and indolent cancers, including overtreatment. And finally, somatic and minimal residual disease, or MRD testing, enables oncologists to optimize surgical resection, identify precision therapies, and monitor for cancer reoccurrence. So it's a great thing to have in this modern world. And obviously, in the medical field in general, it's going to save lots of lives. But how can you seize the opportunity from an investment standpoint? Well, while a 1,500 unit price could unlock the market, a 1,000 unit price could transform the cancer mortality curve. The convergence between and among innovative technologies pushed the cost of multi-cancer screenings down by 20-fold, from 30,000 in 2015 to 1,500 today, and according to ARC's research, by another 80% to 250 in 2025. So here we have cell and gene therapy generation numero dos. Cell and gene therapies are in early days. The second generation of cell and gene therapies should shift from liquid to solid tumors, autologous to allogenic cell therapy, ex vivo to in vivo gene editing. New cell and gene therapy innovations could increase the total addressable market for oncology therapeutics by more than 20-fold. So another 20x opportunity. Cancer therapies are shifting from liquid to solid tumors. Typically, cancer therapies are tested on liquid tumors first. Solid tumors, however, comprise 88% of diagnosed cancers. The U.S. Food and Drug Administration, or the FDA, approved Gleevec, an oral chemotherapy, after 10 years of trials, 7 years of which were in solid tumors. This timeline suggests that the FDA could approve the first CAR/T therapy for solid tumors in 2025. Because of artificial intelligence, gene editing, and next generation sequencing, or NGS, failure rates and time to market should fall, accelerating approval rates. So we'll have to see. That's just something that we're going to have to wait and see. If they're able to do it faster, great. If they have to do it slower, not the best. But FDA likes to take their sweet time with approving anything. So oncology trials are shifting from autologous to allogenic cell therapies. These cell therapies involves cells off the shelf or donated, whereas the old cell therapies modifies the patient's own cells. So here you have the cost, right? So the cost for the ways of doing it before is roughly $100,000 plus, and no risk of cell rejection. Now this one does have the risk of cell rejection, but it's scalable. It's under $10,000. The product consistency is there, ability to redose is there, and expanded access to the sickest patients is also there. Now, as far as the trials go, the recruiting is about 50-50 completed, 60 is autologous now, and 40 is allogenic, and the 100% approved therapies are the autologous as of right now. Now, gene therapies could also shift from ex vivo to in vivo editing. Now, ex vivo modifies a patient's cell outside the body and then transplant them back into the patient. In vivo gene therapy modifies a patient's cell inside the body. So, unlike ex vivo, in vivo therapies cannot check edited cells before transduction. That said, in vivo gene therapy is more cost effective and easier to manufacture and scale. It also enables more access to the liver, eye, central nervous system / CNS, and muscles. So as you can see, ex vivo, higher cost, not scalable, ability to check edited cells before transduction, sure, but product consistency is not there, non-toxic conditioning regimens is not there, and expanded access to treatable diseases is not there. With in vivo, all but the ability to check edited cells before transduction is all there, and the costs are much lower. So gene therapy and editing trials have increased 5-fold since 2010. To date, the FDA has approved only 10 gene therapies. As of year-end 2020, 712 active gene therapy clinical trials were underway. 238 of them were initiated in 2020. Adjusting for the typical trial fail rate, roughly 170 gene therapies are likely to be approved and commercialized during the next decade. So absolutely huge for gene therapy. Gene therapy stages of advancement. So phase 4 here, phase 3 here, phase 2, phase 1. These are the active trials, and then expected commercialization, and these are the approved drugs over here. But what about seizing the opportunity? Well, ARC estimates that allogenic cells and cellular immunotherapies could create $250 billion in incremental revenues. Here is a nice little, almost a pie chart, more of a square chart here for you guys. Go check that out if you want to just take a snapshot of that. This is showing on the bottom late stage to early stage, and on the left here, liquid tumors to solid tumors. And this is the 150 billion addressable market plus the 70 billion here. 13 billion is the current, and 30 billion over here. So when you add this all together, you get a rough estimate of about 250 billion. Innovation in cellular immunotherapies, including TILs, TCRs, and CAR T cell therapies, could increase the addressable market by nearly 3-fold, adding 30 billion to the current $13 billion total addressable market. Allogenic therapies enable easier applications in earlier stages of cancer, potentially increasing the TAM by $70 billion. That's over here. And the combination of innovation and allogenic cells could add an additional $150 billion and increase the overall TAM on oncology gene therapy about 20-fold to more than $260 billion. In vivo gene therapy could enable gene editing to cure thousands of rare diseases over time. So absolutely incredible. If you made it all the way through this video, you're absolutely incredible. You did an awesome job. I hope you learned a ton. If you did, make sure to smash the like button. Make sure to subscribe if it's your first time here. And really, if you want to share this with a friend on Facebook, on Instagram, on Snapchat, wherever you do your social media stuff, it really means the world to me, but it also helps a lot of people learn about these awesome technologies that we have before us. So again, thank you all so much for watching. Thank you for spending the time with me. And more importantly, thank you for making the world a better place. I'm Ruslan G. I'll see you guys in the next one. Peace out.